Fundamentally, if you really see, economic growth has been slow than what it was 6 months back. And even if you see, the festive season has not been great. All the high frequency datas are not that good as you would expect in the GDP growth scenario of 7%. So fundamentally, I think things are slow. Macro is bit weak, and that is precisely now also getting elevated in terms of risk because of the oil prices. So oil price beyond $74-$75 is a big risk to the Indian economy. So be it current account deficit or fiscal deficit concerns will come back. So to that extent, I think we are in that choppy waters where fundamental macro scenario doesn't look that great, and its impact will be seen in the micro, which is the corporate earnings. We are already seeing when we are doing the channel checks, the mid cap and the small cap side will face pressure on earnings or on growth, whereas large cap will still sail through. So fundamentally speaking, things are weak, and maybe it is because of pre-election things are slow. So if you take two-wheeler sales, car sales, tractor sales, CV sales, all high frequency data are not pointing out to a good growth numbers. Having said that, once the government comes into, whichever government comes in, we'll have to see how the reform process is taken, and hope that in next 2-3 quarters we will have fundamentals coming back to its normal level of growth. We are finding pockets of value in auto sector. Maybe it might take 2 to 3 quarters for numbers to come, but obviously there is good value emerging in auto sector, autos and auto ancillaries. Financials, as I said, always is a good evergreen story, and some correction is always good for stocks to enter. Consumption again, maybe 10-15% correction, I think there is a good value emerging. Capital goods also remains a pretty value pick, but at this juncture we would like to wait for the reform story to take shape in the infrastructure sector, and let's say if there are big orders which are being announced by the government for infrastructure, then obviously there is a good value in the capital goods side. Pharma looks interesting with a 3-year view. Again, there is a value emerging, but it will take some time for really to show in terms of numbers. So these are some of the sectors where we're working hard in terms of getting some stock from an investment perspective. Market perspective, whatever has happened in last 6-7 months in terms of economic growth, in terms of some kind of slowdown in economy because of the issues around IL&FS and all those things, I think, and the issues around job growth and other factors. Generally speaking, the markets are discounting a good number for this government, and at this juncture it is like this government will come back to power, which we are also hopeful. And so at this juncture, this is what the market is discounting, and hence you have a rally in March and April. However, if things, elections are elections, so if things change and if the outcome is unfavorable, then obviously you will have a bigger cut in the market. Let's say if this government doesn't come back to power, lesser seats than what the market is expecting for the current government. We'll have to see how the coalition is formed, how the cabinet is formed, what kind of reform process they take, or what kind of populist measures they start after forming the government. So at this juncture, it is like the current government coming back to power with a decent majority. Market meltdown, if it is because of domestic factors, let's say election, let's say just a case in point, then obviously domestic led sectors which are financials, consumption, again auto, will have a bigger hit, and more hit on the mid cap and the small cap side, because any which ways they are more vulnerable if the slowdown comes. If market meltdown is because of a global financial crisis or US-led slowdown, then I think it will be very, very stock specific. Maybe some bit of technology stocks might get hit, but the direct impact will be minimal. So to that extent, maybe IT would be a sector which will take a hit if there is a global slowdown, and some auto stocks which are more overseas dominated. So some of the auto ancillary companies who are exporting more, or some of the auto ancillary companies who have factories outside India, they would be more vulnerable to these shocks. So then it will be more of a 5-10% of the market, not the entire market. But if there is a domestic meltdown for whatever reason, then I think all the domestic led sectors will have its own problem.